Hello and welcome everyone to the Closing Bell Show, where you can invest with the best. This week we chat with Austin Lieberman. He gives us his outlook on the rest of the year for the markets. He tells us why he's added Airbnb and Shopify to his portfolio, and much, much more. We also really appreciate your support on TikTok and all the other socials. We're getting great traction and we're immensely grateful, so thanks for that.
I thought maybe we could kick things off with the ABCs of Austin. And by the way, I read your Substack. I love what you're doing. I love the transparency piece of it. So I'd be keen to know your background, how you got into investing, and then why you default to this kind of like, default transparency outlook across your Twitter, across your Substack.
Yeah. Thanks for having me. Excited to be here, and was happy we could just connect and make it work. It's been a busy time for both of us. My background, I was in the active duty Air Force from 2011. That was the year I got out of college, to 2017, and had been a kind of a self-taught do-it-yourself investor starting. Actually invested a little bit, not invested, traded and wasted money in college. I was commissioning as an officer into the Air Force, and once you sign your contract, it's pretty reliable that you're actually going to commission. And what that means is banks know exactly how much money you're going to make, and it's a reliable income. And so there was a bank that offered what was called cadet loans, which were basically to help you get set up and prepared for life. And you can get it your last 2 years of college, and it's to pay for, expenses your last 2 years, and then moving expenses when you get your first assignment and stuff. So it's like a $25,000 loan at like a 3% interest rate back then. And I used a good portion of it on a cruise our senior year. I bought a road bike. I did buy some stuff for school, but I had most of it paid for because I was working and had scholarships. And I had like $10,000 left over. And so I took 5,000 or 8,000 and started investing, and essentially just like buying the things that Jim Cramer was talking about on TV on Mad Money, and quickly lost a bunch of money owning things. I had no idea why I was owning it. So I got kind of annoyed and fed up. I thought the stock market was a casino and a gamble, and, no reason to invest. And so sort of just didn't do that for the next few years. But when I got to my first assignment in the military, I crossed paths with somebody who was kind of like a mentor of mine, and he was just set financially. And over some time, I started to just like learn how he had gotten that way. And he had actually been a subscriber to the Motley Fool, which is a investment service. It's massive. Everybody that's a fan of Closing Bell's probably heard of it. They've got a US service. They're all over the world. And just very, long-term buy and hold, mostly growth stock type of stuff. And again, this was back in 2011, 2012. He had turned like, I don't know, $6,000 into $80,000 in Netflix. And he had a couple other positions that were just like massive, massive winners like that. And so that was my, first real exposure to do it yourself, long-term, somebody that I knew and trusted that was very successful investing for themselves. And so I started subscribing to the Motley Fool, eventually became a freelance writer and started to do a little bit of freelance community work for them. And that was just my way of like learning investing. And so that was from about 2012 to 2017 or 2018. I was pretty active within the Motley Fool community. And because I had been investing, we were in a spot that we were able to, make decisions that weren't all about money. So we needed to spend more time together as a family. So I was able to leave active duty and wasn't worried about, whether I'd be able to get a job immediately or not. And it was all because we had been saving and investing. In 2000, so from 2018 to 19, I was a business and technology consultant. Did a lot of work with some cloud companies like Salesforce. The company I worked at was a huge partner to Microsoft Azure, Google Cloud Platform, AWS. So really started to learn about some of these like software and cloud type stocks in 2017 and 2018. And that's really where I began my email newsletter, started investing heavily in cloud and growth type stocks. And that's really the same style investor I am now. The reason I'm transparent and share dollar values and stuff on Substack and across social media is because I don't think there's enough of that. And I think it feels like finance is this big, scary, especially now with the way the market's been, world that's just not accessible to normal people. And I would consider myself a normal person, having a military background and I have a criminal justice degree. And so no, formal financial training. And so I guess I just hope that by sharing my journey and my process, the ups and the downs, hopefully people can see that and somehow relate to it and not copy what I do at all, but feel like they're able to, start investing in some way on their own, even if it's with index funds and ETFs. That's totally fine. And that's really it.
Awesome.
The other thing is I started a YouTube channel recently, which has been a lot of fun too.
Awesome. We'll put that link in the comments section. Now, before we get started, I thought I'd ask you a few fun questions. We usually start this off, and I usually have another host, Nathan, who runs product marketing on our side, and he's away today, unfortunately. I think he's off.
Come on, Nathan.
And he,
you're better than him, anyways.
Oh, well, I appreciate that. I'll let him know. I'll remind him who's the boss. But he loves to ask this friend, marry, kill question. And so I've got a friend, marry, kill question for you. So I'm going to steal his little his segment. So friend, marry, kill. If you haven't played before, I'm going to give you 3 names, and you pick friend, marry, kills for each of those names. The first is Brian Chesky, CEO at Airbnb. Tobias, the CEO at Shopify. And then finally, Elon Musk, obviously CEO at Tesla and SpaceX. Friend, marry, kill.
I would marry Tobias. He just seems like such a sweet, thoughtful, kind individual. Toby. I'd be friends with Brian Chesky, and I would never do a business deal with Elon Musk. That's my statement about Elon Musk.
Well, so you've obviously got some feelings about his Twitter dealings.
Yeah.
What are your thoughts on that? I'm not even up to date on it. Is this thing going through?
I have no idea. When it first came out, I didn't think he was serious about it at all. I forget what I said. I said, I don't know what it was. I basically thought he was just like messing around or whatever. And then he appeared to be serious. I've heard him talk about it, and he does seem passionate about the idea of free speech. But then taking every opportunity to try to back out. And I have no idea. It'll probably go through. I mean, at this point, it seems like it's going to, just because there's now like legal ramifications. I think it's supposed to end soon, but I haven't paid a whole lot of attention to it. It wasn't a reason. I guess there was some arbitrage that could have happened with Twitter because, the deal was offered at $54.20 or whatever. And then the stock traded down like in between, down into the 30s or low 40s. And so I think there's a story out there of some funds that just bought a ton of it when that happened because they were sure the deal was going to go through. But I didn't do that. And that's just not the type of investor I am. I mean, Twitter is a company that I wasn't really interested in owning. And I mean, yeah, sure. I guess I could have got an easy, 30 to 40% gain. But then if it would have fallen through, I would have had no interest in owning the stock.
Yeah.
So it's probably going through. Who knows?
Yeah, we'll find out. Now I've got a couple more questions for you. Then we'll get into some of the stocks that you're looking at.
Sure.
Can you remember the first investment that you ever made and why you were interested in it? You mentioned that you invested in a couple of stocks in college, so maybe you got a story for us about a shitty little stock that you invested in, or maybe it was a winner.
Yeah, no, the three that come to mind were AT&T. It paid Jim Cramer was talking about it. It paid a nice dividend. And then Annaly, which was NLY, I think it's a REIT. It paid a really high dividend. And so the thought there was just, hey, I didn't know a whole ton about investing at that point. I loved the idea of, these really high dividends. It seems so safe. You're just going to get paid this money. And then, oh yeah, the stock could go up too. And the lesson there really for me was, you got to know what you own and do some research into the company. But sometimes there's a reason stocks are cheap, and some of the highest dividend payers are actually the most risky investments, because a dividend can go higher for a number of reasons, right? One is that the company keeps increasing their dividend through growing earnings and, extra cash flow. That generally is not the reason that there are ultra high dividend paying stocks. What usually happens is ultra high dividends happen because the stock price goes down significantly. And the problem is then if the stock price is going down because the fundamentals of the company are deteriorating, then the thing that's likely to happen is a dividend cut. And when dividend cuts happen, it makes the stock drop even more. And that was kind of what had started happening with NLY. I haven't looked at it in years, but I would imagine it's either like flat or down from when I owned it back in 2010, 2011. And then I also owned, this was like 2012. And again, it was a awesome Jim Cramer recommendation, but I owned the VIX, but it was like some type of leveraged ETF that was associated with the VIX. And essentially it was a vehicle that it's only made for like owning for a few hours or a couple days max. And if you own these things long-term, they're like guaranteed to lose a significant amount of money, just because of the way the fund works. And that was what happened with that. And I had no idea why. I didn't know what I owned. It was just this thing that Jim Cramer was talking about. So luckily it was a small amount of money. It was a lot to me then, but small in the grand scheme of things. And I learned an important lesson, which is just like, don't listen to random people pumping stuff in markets. And that's been super important, especially with things like NFTs and crypto scams that have been out there, but also stocks too.
Big time. I've been the victim of a couple of crypto pump and dumps, that's for sure, especially back in 2017 when it was fairly new at that point, like kind of like the beginning of 2017, I was in San Francisco and, it was the talk of the town, but nowhere else was talking about it at the time, not in Australia at least. And you feel like you're missing out because everyone's rushing towards it. And lo and behold, 6 months later, you're holding the bag. And you learn, although there were a couple of runaways, like, I don't know if you follow the crypto world much, but Binance, the big exchange, has a coin called BNB. And I bought the BNB like 40 cents kind of when it ICO'd. And I thought this was a great investment. And that was my rationale, for it was that, if this can become the leading crypto exchange, then this is a winner. I sold it when it went to $1.50. So I 3x my money, thought I was a genius. And then I opened up the CoinMarketCap.com website and it was up to $600. And that's like a $3 million investment or a $2.5 million investment. If I had held out and said I got a couple of grand in my pocket. And like you said, at the time it seemed like a lot, but in the grand scheme of things is pennies on the dollar. Now, last question. I need you to think of the top two people you really admire in the investing world. And then I want you to tell me who the second person was that came to mind and why you admire them. And by the way, while you're thinking, the reason why I say the second is because the first is always like Warren Buffett or Charlie Munger.
Yeah.
I want to get you to dig a little deeper for me.
Yeah, I mean, the person's got to be. I mean, the person I'd choose to talk about would be David Garner, right? He's one of the co-founders of the Motley Fool, and he, I mean, just got this incredible record of investing and stocks that he's recommended in these services. And the two services that he essentially was a major part of is Stock Advisor and Rule Breaker. I don't know how they're doing now. I think they're still beating the market over, the 10, 12, 15 years that he was involved. At one point they were just destroying the market. But now with this crazy sell off, they've come down. But, the amount of people, I mean, they have hundreds of thousands, millions, who knows how many subscribers, but, I think, Jack Bogle's obviously done a ton for investors with index funds and Vanguards, but the amount of people that the Motley Fool and David Gardner has impacted and inspired to be investors is up there. I mean, it's in the millions, right? And it started as a small business. It was just like a newsletter service with two brothers, and now it's become this massive, massive thing. And there's a lot of things about the Motley Fool that annoy me. Their marketing, some of it has just been crazy and excessive and annoying. I think they've actually gotten better about it over the last few years, but their services and what they teach about long-term investing and owning companies, it inspired me to be an investor. It is something that works for normal people that don't spend every second of the day staring at the market. And he's got the podcast called Rule Breaker Investing. And one of his things is like, you'll be a better investor if you live an interesting life. So go do things that you enjoy your life. Don't just obsess about the market. And that's a pretty freeing thought for people when a lot of stuff out there makes the market out to be this crazy complicated thing that you need to, pay attention to every second of the day and get alerts every 10 seconds on your phone. So David Gardner.
Awesome. Now you have this Substack, austin.substack.com. It's called The Growth Curve. I was keen for you to just talk me through kind of how you're thinking about positioning your portfolio over the next, in the short term, over the next maybe like 6 to 12 months. The market's obviously very volatile. And you're transparently showing your portfolio. You're putting it all on the line, which is awesome. Do you have a view on how you're going to position your portfolio, and maybe you can comment on some of the winners and losers in your portfolio to date, and why you think that might be the case?
Yeah, it should be called the shrinking curve at this point. Yeah, I mean, I share it pretty transparent. I've got it pulled up now. And so for context, this is a portfolio I started February 15th, 2022. So just this year. It's a little bit nuanced, but again, I'm a self-taught investor. I had an amazing opportunity to be a portfolio manager at Social Capital. And I did that for a year. I did it from 2021, March of 2021 to March of 2022. And that was the first time that I had ever had my job tied to the stock market, because I was an investor. And previous to that, all my income came from the military. It was very secure, totally not associated with the stock market. And so it was just uncomfortable for me. It was an uncomfortable transition to have the majority of my wealth invested in the stock market, which is what I had all the way, building up from 2012 to 2020 and early 21, essentially. And so at that time, I took most of what I had previously had invested and just took it out of the market. And we had some expenses too and some other things. But anyways, I did that for a year, and there was some restrictions and trading restrictions just because of the job I had. And so essentially I restarted my portfolio. It wasn't timing the market or anything. It was literally because of the job I had was previously associated with the market, and then it wasn't. But the market started dropping. Back in February, we had already started what is now this pretty significant bear market. And I'm not good at timing the market, but I thought like, hey, this is an opportunity to, try to start a long-term investing track record and sharing this stuff transparently during a time that is, it's volatile right now. I forget how much the market was down at that point, but it was, the excitement was all gone from 2020 through early 21. And people were starting to get nervous and the stock market was starting to go down. And one of the things I always appreciated about the Motley Fool is they kept investing, through ups and downs or whatever. And so I thought it was a cool opportunity to just start sharing transparently and be somebody that was out there investing and sharing the journey during what could either be a short downturn or a long downturn or a long bear market. And so that's the context that I started the portfolio I'm sharing now with. And it is now the everything that I have invested in the market is shown in this portfolio. And I'm adding to it pretty significantly. I've added since February 15th, 2022, I've added $118,000. It's currently worth $108,000. So we're down about $10,000. It's been a good week or month. I mean, it's up. I was down a lot more than that, and we've rebounded quite a bit. So that's the context. That's the portfolio, and it's invested in. I own 1, 2, 3, 4, 5. It's like 13, 14 stocks. And my outlook is that I think I was excited about investing. Starting this portfolio in February, I did think like, hey, valuations could come down, the market could go down or whatever. But I had a plan to invest, every single month, and I was okay starting early and seeing things drop, and because I know that over time it'll catch up. It turns out I was way early, and things were way overvalued, or at least compared to where they are now. And so if I was excited back in February, or if I was excited in March, April, May, or June, then I better be excited about the companies now when the valuation is cheaper. And in my opinion, the multiple is lower. So if you go if it's a SaaS stock, they're generally rated price to sales ratio or enterprise value to sales. If you go from 20 down to 10 and the fundamentals of the business are the same, they're still, a leader in their industry, then you better like that investment more now than you did when you were buying it at a enterprise value to sales of 20. Example being Snowflake. I mean, they're growing still in the 80% range year over year with 170% net dollar retention, which means, a customer each year is spending 170% of what they spent the previous year. So 70% more. So it's a fantastic business, and it's executing extremely well. The only thing that's happened is the multiple has come down. And so my thoughts are that I was excited before and I'm more excited now. And I think that there's a better opportunity now to outperform the market or, grow a portfolio than there was a few months ago when everything was more expensive. And so my plan is to just keep adding every single month. Not using margin, not being crazy, not doing anything like that. We don't need to do it. And what I want to do is build a track record. It sounds super boring, but over 5, 10, 15, 20 years. And if I can keep working, keep investing every month, then, and I'm not just going to blindly own these companies, then I think now is a fantastic time to be buying into a lot of these companies that are fantastic companies, but have just been crushed due to inflation fears, interest rates rising, the death of growth companies, all of this stuff. So I don't know if the bottom's in. I'm sure the market will go down more or whatever. It doesn't matter to me. And if we are the best thing that can happen for say your time horizon is 10 years. The absolute best thing that could happen for your portfolio is for the next 5 years for the market to be flat or down. while you are continuing to add money every single month. And then what you would want is, I try not to invest any money that I might need in the next 3 to 5 years. My time horizon is really like 20, 25, 30 years. But if in this example, my time horizon is 10 years, I'd want the next 5 years to be, really the next 4 years to be flat to down. The 5th year, I would want everything to go up 200 and 300% because I have been buying all along. And then since I was 5 years from needing the money, I would then start to take out, anything I might need in the next 5 years, basically. So I wouldn't want the portfolio to go down anymore at that point. Confusing example, but that's how I think about stocks. And it's a hard concept because you want your portfolio to grow and you want your stocks to go up, but technically you should actually want them to stay flat to be down until you're about 5 years from needing the money.
Yeah, no, that makes complete sense. So taking the opportunity out of dollar cost average on the way down, and then in the next couple of years, hoping that it absolutely rips again. And I'm sure, growth stocks will have their time coming in because there's actually a number of really impressive businesses now that are being built. And so, yeah, they're growth stocks, but it's not like there's no promise. This isn't 1999 where a lot of these businesses were just kind of built on absolute horse shit.
Yeah.
Really, Snowflake's a great example. Zoom's a good example as well, of businesses that are performing quite well. You mentioned Social Capital and Chamath, and I've been a fan of Chamath from maybe 2015, 16 before he kind of blew up in the news. And then he got really big through that Stanford presser that he did where he was talking about social media, ruining the fabric of society and all of that. That's kind of when he got into the map. And then obviously the All In podcast. And I know that he put out that program, which is basically like come and become a portfolio manager at Social Capital. But I was hoping you could explain to me what actually the program was because I can't recall. And then what that kind of, I'm curious what that process was like and then what it was. So the hiring process, but then also internally, like what that looked like operationally.
Yeah. I can't share a ton of, honestly, I don't know what I can and what I can't share. So I'm going to err on the side of not sharing a whole lot. Basically the program was they started this thing called Emerging Managers, and it was designed to be an opportunity for people from, not from traditional finance backgrounds to become professional money managers. And so essentially you apply and it's one of the cool things about like the power of social media, right? I've spent time, and it annoys my wife, it still does, about time on Twitter, and time building an email newsletter, YouTube channel, whatever. And a lot of time you feel like you're doing it and you're just like, what am I doing? This is such a waste of time. But every job that I've gotten since I left the military, I'm still in the Air National Guard, but since I left active duty, has come through either connections I've made through Twitter or through my email newsletter. And so if anybody's out there, if you're an investor and you're thinking about starting on social media or starting a newsletter or whatever, my recommendation is do it, make time for it. I've got 3 kids. I was active duty in the military. I'm still in the Guard. I have jobs. I do side stuff. You can make time for it if you want to prioritize it. But it was a really cool concept. The opportunity for somebody like me that has a public university degree in criminal justice, spent time in the military, not at some investment firm or getting an MBA or anything like that. I would never have a chance at to be a portfolio manager or really to work anywhere in finance. At least that's kind of what I thought. And so, yeah, there was they wanted a 1-pager about a pitch, and then there's a round or 2 of interviews, did that. And then I had a quick meeting with Chamath, and he was incredibly kind and thoughtful. He asked by name. I included, I'm a family person, so I included my wife's name, my kids' names and stuff in the application. But he asked about them by name and asked how they felt about me getting, taking that job or about the opportunity. He was just incredibly kind and thoughtful. And he really, it wasn't like a pressure interview or anything like that. He was just really nice in the interview. And then the program was a lot of fun. I joined with like, I think 9, 10 other people. And we had a lot of freedom and a lot of responsibility too. And it was something I wasn't experienced in and wasn't super prepared for. It's a lot. So most funds, at least to my understanding, you've got your portfolio manager, but then you have a team of researchers or analysts or whatever that are helping research stocks and stuff like that. And we were our own portfolio managers, but then we also did our own research and stuff, which was awesome and fun and liberating, but it was also challenging. And so, yeah, I did it for a year and then ended up having an opportunity to join a different company, a startup that's in the finance space. And so did that starting in March of 2022 and was laid off from there due to budget cuts in this crazy macro environment. And now I actually work at a company called ConvertKit, which is
Another one.
Yeah, an email software platform. I've been a super fan of ConvertKit and the founder, Nathan Barry. I mean, if you're on Twitter, you've probably heard of ConvertKit.
Yeah, I love it.
And it's great. Like it was a super, you didn't even ask about this, but it was like a super stressful transition going from, it was super stressful being a portfolio manager, at least for me, especially with the way the market played out, towards kind of the end of 2021 into 2022. But then it was also super stressful, getting laid off from a job shortly after joining, because of macro conditions and, the VC world, people not being able to raise money and stuff like that. But then to land where I'm at with a company that I've looked up to for a very long time, that's super profitable, bootstrapped, never had to raise a dime from venture capital, just feels like a blessing. And it's like a creator company, which they encourage me to do things like write my newsletter, have a YouTube channel, be active on social media. So it's an awesome fit.
That's awesome. Just on the, well, firstly, I follow Nathan Barry and I love ConvertKit, and there's another business similar, called Gumroad. They're not in the same space, but the same sentiments, like creator focused, boots. I think the story of Gumroad is that they raised venture capital, but they paid it all back, and now they're bootstrapped ultimately. And Sahil, so I look up to these kinds of guys in the best way. So I think that's an awesome place to work. On the social capital front, and I don't mean to dig on this, but I'm just curious, do they give you the capital? They say, here's X dollars, and then they say, run with it? Or is there like every day you're giving updates, and like, what's the cadence that they're working at in order to manage that money?
Yeah, we had some guardrails or restrictions in terms of like position sizes and things like that. And we had check-ins. It wasn't every day. I mean, you couldn't go be like a vigilante and YOLO like calls or puts or, anything crazy. Like it had to be somewhat of a logical strategy. And again, there was like position size limits and stuff. But we had a lot of freedom and, not a ton of meetings, but we had, weekly or multiple times a week, like check-ins, and, obviously had to check in with like the manager and sort of explain, hey, update on the portfolio and sort of your rationale and stuff like that. But, it was like, if it was my money, I wouldn't have been comfortable giving people any freedom with it whatsoever. And so like, it was an incredibly, kind of like liberating feeling to be able to sort of like, hey, this is my shot. I've got a chance to do this. And I'm either going to make it or break it on my own. Right. And, it was a good experience overall.
Awesome experience. Now I'm going to switch gears just slightly. I mentioned in our chats on email that I was keen to chat about Airbnb and Shopify. We might not be able to get to both of them just because of time, but I mean, what's your preferred company? Do you prefer Airbnb or Shopify right now?
I think I own both of them, but I mean, I think Shopify has more upside, just because of how much they're both amazing companies in my opinion. But I think Shopify has just traded down to ridiculous levels. It could get worse. We're at the beginning of we're probably in a recession right now. Who knows? I'm not making a call one way or the other. So Shopify could certainly go lower from here, but if I mean, it's e-commerce, right? And they're essentially providing all the tools and services and platform that a business could need or a creator could need, or a company could need to sell online and offline as well now. And when you think about that, just like e-commerce and logistics, essentially, they're even getting into NFT type stuff and digital, all that type of stuff. There's just so much opportunity there. And it's a market that is it'll get hurt in a recession for sure. But e-commerce is still in its early stages. And I mean, you can't compare Shopify directly to Amazon, right? Because Amazon they're completely different business models, and Amazon obviously has AWS. But if you look at the size of Amazon's retail business, if you look at the size of e-commerce, if you look at the size of just commerce in general, there's almost endless opportunity there. And at some point, unless the company totally fails, you don't need, the tricky thing about growth stocks is, you either need multiple expansion, right? So price to gross profit to increase, or price to sales to increase, or if you own a profitable company, you need the PE ratio to increase, right? That's one way that a stock can go up. When multiples are elevated, which they clearly were back in 2000, the last half of 2020 through 2021, even into early 2022, one piece of that whole ratio or factor of stocks to increase in value, it's not, the potential for that is much lower. The probability of multiple expansion when multiples were as high as they were is very, very low. So what that means is when multiples are really high, that means the only thing you're relying on is revenue growth, earnings growth, or, gross profit growth. Now, when multiples have come down, you don't need multiple expansion. If it simply grows anywhere as fast as, profits do, or sales do, or earnings do, when multiples come down, then you have a stock that can return 10, 15, 20% per year for a few years. But then if you get multiple expansion, so in Shopify's case, I'm just doing EV to sales just because it's quick. People are going to say, oh, you can't use that. You got to do price gross profit, whatever. The forward EV to sales ratio is like 5.85. So even if it stays at that, and if revenue grows at 15% per year, which I think it can grow faster than that, then if you take out share dilution, essentially the stock is going to go up 15% per year if it stays at that and the sales grow at that rate.
Yeah.
If the EV to sales ratio goes from 5.85 to something like 6, 7, or 8, and the sales increase or the profits increase, then you get the benefit of profits increasing plus that multiple expansion, which adds another, 10, 15, 20% or whatever it is, to the share price. And that could be, over just a few years or whatever. So we're at a point now where for this stock to work out, you don't need multiple expansion, and it could simply work out well just based off sales growth or profit growth alone. Now the thesis could be, or somebody's antithesis could be, well, there's too much share dilution. They're never going to be profitable. They're going to get beaten by Amazon or TikTok or, whatever.
Mm.
If that's somebody's argument, then sure, that's fine. But I think the argument that it's overvalued or, excessively valued, I think that argument has now, I mean, the people were right a year ago, but it's now played out. Right. And so, I think it's important to not, let the drop in share price dictate how we feel about the company. If you like the company, this is in my opinion, because I own shares, not a recommendation to anybody, this is a great time to be starting or building a position. Um, and so Shopify too, it's down. This is gonna blow anybody's mind that's listening.
It's down 80% from all-time highs.
Yeah, it's down 80% from all-time highs, but I'm trying to look at but over the last 5 years, so it's down 80% from all-time highs. Over the last 5 years, it's still up 170%, which is crazy. And so the point is that things got extremely crazy overvalued. I'm not arguing that, but even if somebody had bought it starting 5 years ago in dollar cost average in, like, I don't know exactly how that would work out. They wouldn't be down 80% if they just bought it and then were adding every month starting 5 years ago. They'd probably still be down, but might be flat. And that's with an 80% drop, right? So, 5 years isn't a lot of time in the grand scheme of things. And so think if this company doesn't implode and go to zero, think about what could happen over the next 5, 10, 15 years if they continue to execute, right?
What is impeding them from sort of achieving profitability? Is it because they're investing in growth? I don't know Shopify well. I know old Shopify and I new Shopify, but in terms of the stock, I think their net profit margins are quite bad. What's stopping them from turning a profit?
Yeah, I think it's expansion. So they spend a lot on marketing. They laid out like 4 key investment themes, which is where they're spending a lot of money. And the 4R is building buyer relationships. And so what that looks like is marketing, getting buyers on the platform, but also improving everything from infrastructure that could be different shipping options, the actual like servers and speed of the platform, investing in technology and infrastructure. The second is going global, and so that's just continuing to expand globally, which costs money. Third, they say from first sale to full scale. I'm not sure exactly what they meant by that, but then fourth is simplifying logistics, and that's for everybody from buyers to sellers. And so right now they're just investing heavily. They're still investing heavily in growth, and that's everything from marketing to providing logistics opportunities. And I'm willing to accept that. I do want to see them start to show a path to profitability over the next few years. But if we look at Amazon wasn't profitable. I'm trying to pull it up. I don't know if Amazon is still like profitable on a consistent basis.
Well, definitely for their first probably 10 years, they were unprofitable, but longer.
But I think even more than that, right? Like I'm looking back. Their EPS, their earnings per share, this is adjusted. It's not even GAAP, was, they bordered the line of having negative earnings per share really all the way up through 2017. And so what did they IPO in, I don't know, 97, 98, 99, something like that. So that's
20 years now.
20 years almost. And it's been an incredible investment, right? And it paid off. But the thing is that doesn't mean that every company has a blank check to just be unprofitable forever, right? We need to see them continue to grow sales, grow gross profit, bring on more merchants, bring on more buyers. And so I'm not just saying to like blindly own Shopify or any company, but I am willing to allow them in my portfolio to be unprofitable as long as I see them appear to be investing for growth, which I think they are.
Yeah. Awesome. Now, before we wrap things up, I just wanted to get your breakdown from you of maybe one of the smaller positions that you own. I don't know. I haven't seen the full list. I don't have the full list in front of me of the 13 that you own, but maybe there's something that you're looking at investing in, something you're really excited by that maybe isn't in the public sphere. Does anything come to mind for you there? And maybe you can break it down for us if there is.
Yeah. A company called Rocket Lab. It's, I'm trying to look at the market cap right now. It's about a $2 billion market cap company. It is volatile. They de-SPACed, I think in 2020, maybe 2021. But they grew. I'm just looking at their earnings growth.
Yeah, actually, I do know Rocket Lab. A friend of mine, while you're looking up the detail, a friend of mine, he started a company he's in New Zealand. He's a Kiwi. And he started a pretty cool business, selling parts. It's a car parts business, but he was an aerospace engineer at Rocket Lab.
Nice.
Yeah. And I just connected the two then.
Yeah. Awesome. Yeah. So, I mean, background on the company real quick. They right now are essentially a company that launches satellites to space. They have it's a small, payload rocket called Electron, which has had I think it's 31, I'd be getting this wrong, 31 successful launches, and they've had almost 100% success rate, which is just incredible. They've done some like extremely complicated missions. They did one with NASA, which was like this capstone mission. And it's part of this whole thing leading up to NASA essentially creating a depot station that is going to be used to basically like outfit and get rockets set up and different things set up for logistics, like to and from the moon. It was just this like highly complicated, crazy mission that they pulled off successfully. So right now they primarily do launch. They also do space systems, which essentially is building satellites and just providing vital components and software within them. But then their third market, which they're not in now, but it's like their largest growth opportunity by total addressable market. They're setting themselves up to be positioned to access what they call is the expanding space applications market. And so this is everything from, every GPS we use on the ground and every cell phone relies on GPSs. There are so many things that we use as services every day as little earthlings down here across the world that rely on satellites in space. And they call that it's like a $320 billion total addressable market. There's other firms that have I think they're pulling that data from. So it's not just them pulling that $300 billion TAM, making it up, but total addressable market should be taken with a grain of salt. They have, under $1 billion in total revenue right now. And these three different segments that they're in, launch services, space, and space applications, have in total about $380 to $390 billion total addressable market. So even if they can grow from under $1 billion to 5, 10, 11, or $12 billion in total revenue over the next, 10 or so years, there's an incredible opportunity there for this company. And they're actually developing Neutron, which is their large payload rocket that's going to kind of go head to head in some ways with SpaceX. And the next decade or so is supposed to be like a massive decade for spending on sending things to space. We're already kind of seeing that start to happen now. And they're a pretty established company. They've got real revenue. They've done a lot of successful launches, and they have a lot of pretty awesome customers, ranging from private sector to the government and everything. They're real active on Twitter. They've got a YouTube channel. So if you're interested in learning about the company, just check out Rocket Lab, Twitter or YouTube, and they've got some awesome videos.
Yeah, it looks like they're doing $60 million odd. Yes, it was 31 launches, 151 successful missions. And actually, it's interesting because Elon's really pushing Starlink now. I've noticed it ads on Facebook, and Elon's not really one to push and do sort of paid advertising, particularly for Tesla and SpaceX. But this kind of like low Earth orbit industry, because there's a lot of, I mean, you and me at least, we're in areas where internet is fairly accessible, but there's so many parts of the world where you literally can't get access to internet or reliable access to internet. But once you unlock those areas, you're going to get expansion in global economy on that basis, just because you're going to unlock so many more people who can become educated, who can learn, who can add to the economy, who can add to the global economy, especially in a work from home era. So I think the next 10 years, it's going to be huge for that space. And I've been following very closely.
Yeah. And an interesting, competitive advantage that they have is they've actually got a launch complex in New Zealand, and their CEO, Peter Beck, he talks about this all the time. He's a amazingly just smart individual, but he's like the polar opposite of Elon Musk. He's like quiet and reserved, and Rocket Lab is all about, they just had their investor day, and they're all about doing what they say they're going to do, which I own Tesla, but Elon Musk and Tesla and even SpaceX, not always known for doing what they say they're going to do, at least not in the time that they say they're going to do it. But what Rocket Lab has done is they've actually built this launch complex in New Zealand, and is actually considered critical national infrastructure for U.S. government customers. And they've got their own dedicated launch control facilities. And it came down, they have a bilateral treaty that allows their U.S. rocket to launch outside the U.S. And it took just like a lot of work. They had to get the airspace designated and all this stuff. And it's a really hard thing to replicate. But what it gives them is 132 launch slots every year. And most launches happen, I'm not a super expert on the space industry, but most launches happen at like shared launch sites. And they might be shared between NASA and other, other countries and commercial space companies and contracting companies, all this stuff. They have their own dedicated site with 132 slots annually. And so what that does is if weather's messed up, then if you notice, like if a NASA launch or even a SpaceX launch gets canceled, they might have like a 2 or 3 day window. But if they don't get it off in those 2 to 3 days, then they've got to wait sometimes like 3 months, 6 months or whatever until they have the next slot that's available at a site they're launching at. They have a launch availability date, it's every 2 to 3 days at their site in New Zealand. And so when you think about moats and competitive advantages and stuff like that, they've got a pretty solid one with the way that they're set up with their complex in New Zealand. Then they have another one in the United States, which is more of like a shared site in Virginia.
Yeah, I'm so glad you mentioned this. Actually, I was looking up Peter Beck. The guy has never been to university. He just made rockets by himself.
Yeah, that's my kind of CEO, right?
That's my kind of guy. And that's so interesting. I mean, Elon's kind of similar. He ended up, he left his masters, but it's always these big companies they're always run by people who are like, even like a Richard Branson kind of character is one of my favorite entrepreneurs. Sometimes these big bold visions come from people who aren't institutionalized. They haven't been molded by what in quotations, what is possible, what isn't possible. So I think this guy's going to be up there as one of your favorite founder entrepreneurs.
Yeah.
Austin, then I really appreciate having you on the show. You're always welcome to come on and talk about any of the new investments that you're making. So this is your platform. and then we can wrap up.
Yeah. My email newsletter is austin.substack.com. And then on YouTube, if you search Austin Lieberman, I should come up, and they have this tag thing on YouTube. I don't think it's active yet, but I actually reserved the tag on YouTube of growth investor. Don't think it'll come up yet. So just search Austin Lieberman, AustinLieberman. And if you want to support me, the newsletter's free. YouTube's free. I'm trying to do everything for free. Cause I do have a job, and I'm just trying to provide information to people for free.